Welcome to the Financial Quarterback with your host, Jim Lineweaver.
Hi, I'm Jim Lineweaver, your financial quarterback since 1993. Today we have a special guest with us, Jerry Herman. He's a chartered financial analyst, and he's also the head of our investment committee. So Jerry, welcome back to the show. So what do you see for the outlook for the markets through the end of the year?
Well, if the year actually ended today, this would represent a pretty good year in historic terms. Through July, the market was up 18%. If we can hold that watermark, it'll compare very favorably to the historic rate of 11 to 12%, 50% above average. However, August has been a bit more volatile.
Yeah, and we might be heading that way in September and October too, because traditionally September is one of the worst months, averaging only about 1%. But if you combine September and October, it's kind of the worst months of the market. However, the fourth quarter, we do usually see an uptick, don't we?
Right, and as I look into the fourth quarter, I think there's three key things. First is the economic restart, second, Fed policy and interest rates, and third, inflation.
Well, as tired as everybody is about the pandemic, why don't we start there?
Well, there's a lot of concern about the Delta variant, although the economic restart, while not bulletproof, looks to be underway. And it's being driven by a few things. First is the availability of vaccines, the economic stimulus, pent-up demand for goods and services, and high savings rates.
Well, it seems like the vaccines are kind of kicking in. About 70% of the adults have had them through August, and it seems like they're sitting on a lot of cash, because back in March there was a study that said people have 27% sitting in their savings account, so that money can be deployed sooner or later.
Right, and the economic stimulus was huge in reaction to the pandemic. It was 25% of GDP. As a reflection of a strengthening economy, corporate earnings expectations are rising, and GDP is expected to be up 6.5% to 7% this year.
Yeah, so that really kind of brings us to the Fed, which has really kind of kept rates artificially low. Matter of fact, with inflation target only about 2%, but it seems like inflation's really much higher than that, but a lot of people think it's transitory. But is this a situation where they might kind of overheat the market a little bit if they let this go too long?
Well, that brings us to inflation. Inflation in July and June actually was 5.4% compared to a historic average of 2.9%. But if you look at yields at about 1.4% on the 10-year Treasury, 2.4% on bonds, with 5.4% inflation, purchasing power actually erodes.
Yeah, so if actually somebody's invested in bonds, they could actually be losing ground because of inflation if they're looking at their total return.
That's right. Historically, equities tend to do better in inflationary times, but not all equities are created equal. And a recent study by BlackRock actually indicated that investors are underweight equity inflation fighters in their portfolio.
So yeah, investors tend to de-risk their portfolios, especially as they get closer or into retirement. So for retirees, it's more important than ever to make sure you have a good financial strategy in place to make sure that you're not losing ground due to inflation. So if you have any questions about your portfolio or you'd like a second opinion, give us a call. Here's Chris Wallace.